Today's monetary system is controlled by banks, private banks, commercial banks, whose main purpose in life is to make money. But money itself is, I think, a public good. It should be treated as a public good, like water, like air. It's something that we all need in order to exchange things with each other. Okay, it's much more effective than bartering things with each other, because with money we get round the problem of the thing that we have needing to be exactly the same value as the thing we want from somebody else. So we do need money, but there's a big question about whether we need it to be issued by these commercial banks. So these days, 97% of money in circulation is created by commercial banks. And they create it as credit. They give you credit, they give you a loan. That means it's also debt, because obviously if you create credit, you're at the same time creating a debt on behalf of the person who's received the credit. Now, this doesn't necessarily have to be a problem, but it is a problem when the people creating that credit or debt are charging interest upon it on the basis of creating money, of creating profit. And it hasn't always been this way. There's a kind of interesting sleight of hand at the heart of the way money's created. It's called fractional reserve banking, our monetary system. And a lot of people think that the way banks work is you put your savings in the bank, and the banks recycle those savings and lend it out to other people who need it more than you, because you're putting it in the bank as savings. That's just not the case. That is just a sort of myth that I fear that the bank and certain governments are very happy to perpetuate. The real way that banks work today is you put some money in the bank, or the central bank puts a deposit in the bank, and that bank then issues money on the basis of that deposit. And this is called fractional reserve banking. So the reserve ratio in the UK is around 1 to 10. So if £100 goes in the bank, they can then issue £1,000 as a loan, as debt, upon which they charge interest. However, it doesn't stop there. This is the key thing. Once that loan's been loaned out, once that £1,000 been loaned out, it counts as an asset on that bank's balance sheet. Okay, effectively that means they have £1,000, even though it doesn't really exist because you haven't paid it back yet. And they can then lend that money out themselves again. And the other banks where you put that money can do the same. And economists and policy wonks and people in the Bank of England call this sleight of hand the money multiplier, to make it sound like it's just something that, you know, only economists should really understand and know about. But it's really, really important. It's the way the banking system works. And it effectively means that the more money goes into circulation as debt, the more money there is, the more money banks can then create. And it just goes on and on and on. So you get these enormous sums of money, and Ben can maybe talk about the numbers, flowing around. And so the more debt there is, the more money there is. And effectively, we have a situation where money is debt. That is the system that we have. Now, that's fine as far as it goes, but there's a big problem when some of that debt goes bad. And essentially, this is what happened in the financial crisis. These banks, which are focused on making money in the short term by charging interest on this debt, ran out of places where they could loan the money in a sort of sensible fashion. So they started lending it to very, very poor people in America so that they could buy houses, pretty much in the full knowledge that they wouldn't be able to repay that mortgage debt. These are called mortgage-backed securities, or derivatives. And those people couldn't pay that, and eventually there was a house price collapse. And all of that debt at the bottom of that pyramid collapsed. And lots of money. What they did with those mortgage-backed securities is they packaged them up with better quality debt and sold them around the world. These investment banks sold these packages, they're called derivatives, to things like Norwegian pension funds. And what happened when those Americans, right at the bottom of the pyramid, couldn't repay their debt on their mortgages, is the entire world economy collapsed, because so much of that bad debt had been circulated throughout the economy. So rather than talking about bonuses and capital reserve ratios and capital adequacy rates, which are the complicated words that our policymakers use to try and convince us that we don't really know anything about how to reform the banking system and financial services, I think we should start talking about how money is created and who creates it. and what money is, really, and whether this is the most sensible way forward. One thing that I definitely think is true is that we should not be leaving it to these commercial private institutions to create money. It doesn't make sense. And the reason for this is we're sort of pretending that these banks operate in a free market. Just like any other company, they have to compete with other companies to create goods and services that we actually need, and they'll go bust if they don't do a good job. That's just not the case. These banks are given the privilege to create money and charge interest on it at no cost to themselves whatsoever. They are just basically making free money for themselves. And if these debts go bad, they don't go bust like normal commercial organisations. The taxpayer bails them out. We bail them out. That is the system. It's not a free market system. And a lot of free market economists know there's a problem and are writing in newspapers like the FT saying we need to reform this system. So that's the way it works at the moment. Now, there's a long history in America of criticism of this kind of system. And I'm just going to read you this quote by Thomas Jefferson, who's one of the founding fathers of the American Constitution, when he cast a grave warning of what would happen if we allowed the situation that we have in the global economy and in the UK today. He said, this is in 1802, in a letter to the Treasury Secretary, so the equivalent of George Osborne today. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, which is the problem that a lot of people are talking about now, the banks and corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. The issuing of power should be taken from the banks and restored to the people to whom it properly belongs. So this was, 200 years ago by one of the greatest American leaders. And he was pretty much ignored because we've just seen the system become more and more and more concentrated over the last 200 years. Now, it's not necessarily a conspiracy. A lot of people say it's a big conspiracy, but it's a complicated system that's evolved through the deregulation of the financial system and also through the emergence of digital money, which means that banks can essentially can create money through this kind of sleight of hand digitally. Now, we're not allowed to just issue currencies as legal tender. We're not allowed to create something and substitute it for sterling. But banks kind of are. They're allowed to do that with digital money. They've been given permission, effectively, to do that.